Kevin Gordon of Charles Schwab joins me here now post-nice. Nice to see you. Welcome back.
Hey, Scott. Nice to see you.
What's your read on all this as you've listened to our conversation from the top?
Well, from a sentiment standpoint, actually, I love what Bryn was just talking about in terms of, when you get stretched valuations and you get really hot sentiment and then it flips, a little bit on a switch, really, it can really send a name or an industry or a group of stocks in the other direction. And it kind of brings me to a theme that we've had for a couple of quarters now, but especially heading into 25, where when you look at the sentiment environment in 2024, a lot of the metrics that we track were sort of stuck in extreme optimism territory for a good chunk of the year. You really had only a couple of periods, whether it was, early April to late April or into that midsummer drawdown, where some of that froth got washed out and then it came back pretty quickly. So the environment and the ground is just a little bit shakier heading into this year because you had gone through a really long stretch of sentiment being in extreme optimism territory. So it's not a reason in and of itself for stocks to just sell off automatically. But when you have that kind of shaky foundation and you have a little bit more vulnerability, opens you up to more of a drawdown when you do have some kind of negative catalyst that enters in.
I mean, do you feel like we're on the precipice of a narrative switch, of a sentiment change? Because as we also discussed with Bryn and Steve Leisman to start the show, there's still a lot of optimism about what's going to happen with the new administration, despite some of the concerns about sticky inflation and escalating deficit.
Well, the problem is you have all of these cross currents. I mean, from a policy standpoint, you've got on the pro-growth side, less stringent regulation, maybe a rollback in regulation, maybe something that's more beneficial from a tax policy standpoint. But there's also a timing mismatch here because you have relatively aggressive tariff policy that's being proposed. You also have relatively aggressive immigration policy that's being proposed. And, I think it's human nature to look at all of these proposals and sort of take them at once and say, here's the ultimate hit that's going to happen. But we know that that's just not the case. So I think that's the benefit for investors and probably the benefit for the economy for most of this year, if not all of this year, where, if you exclude tariffs, everything from an immigration standpoint, from a tax standpoint, takes a longer time to implement, especially for taxes. I mean, that's not something that the president can do unilaterally. So that's why we focused a lot more, or we are focusing a lot more on what could happen from a tariff standpoint and from an immigration standpoint. But probably tariffs gives you that first hit and then immigration follows on thereafter. So you have to look at the sequencing and what the result is. And I think from a growth standpoint, I actually have maybe it's a little bit more of a contrarian view from a tariff standpoint, but I think that the risk is more on the growth side, not as much on the inflation side, unless you get some significant retaliation from other countries and you really go into a full-blown trade war. The tariff increase itself is really more of just a one-time price level increase. I would look to the sort of knock-on effect after that from a business capex standpoint and see if that materially slows and then in turn takes a hit to growth.
I mean, investors are clearly a little spooked by the move in rates.
Yeah.
Are you?
Not as much, because I think right now it's still consistent with a relatively healthy growth backdrop. It's not like we've seen some dramatic fall in nowcast estimates for GDP growth heading into this year or even in the end of last year. I think that if you got for some reason a material weakening in the labor market, so if Friday's jobs report was really weak, but then you got some heat from CPI and PPI and therefore PCE, then I would grow a little bit more concerned. But I think one of the reasons that you haven't seen as steep of a sell-off, even as the rate of change in something like the 10-year has really picked up and you're getting, closer to 4.7 and breaking, closer to 5%, I think one of the reasons is that because the growth backdrop is still relatively firm. And you have to keep in mind, too, if you kind of take a longer-term look at the 10-year, longer-term in the sense of, the past 3 to 4 years, you have gone through these bouts, most notably probably that July to October 2023 period where the 10-year did get up to 5% for, a hot second and then it reversed. But when you got to that point, there was a significant pullback in the market. But over that time, we've obviously been able to move higher, not without a lot of drawdowns. So I think that the level is maybe not as important as the rate of change in certain instances.
Well, the rate of change has been significant since September. I think
absolutely.